Welcome CFA candidates. Portfolio management is a cornerstone topic in CFA Level 2, integrating concepts from economics, quantitative methods, and finance to help you understand how portfolios are constructed, managed, and evaluated. While much of this subject involves computational techniques, many critical concepts focus on strategy, theory, and interpretation. In this session, we'll cover the non-computational aspects of portfolio management, including investment policies, risk management, asset allocation strategies, behavioral biases, and more. Let's dive in. 1. Portfolio management overview. Portfolio management is about balancing risk and return to achieve an investor's financial goals. At its core, it focuses on answering three questions. What assets should be included in the portfolio? How much of each asset should be held? How should the portfolio be monitored and adjusted over time? The goal is to maximize returns for a given level of risk or minimize risk for a target return. Achieving this involves understanding both investor objectives and market dynamics. 2. Investment Policy Statement, IPS. The Investment Policy Statement, or IPS, is the foundation of portfolio management. Think of it as a roadmap that defines an investor's objectives, constraints, and guidelines for managing their portfolio. Key components of the IPS. Objectives. Return objective. What return is required to meet the investor's goals? Risk tolerance. How much risk can the investor handle emotionally and financially? Constraints. Liquidity needs. How much cash is needed and how soon? Time horizon. Is the goal short-term or long-term? Legal and regulatory factors. Are there restrictions on what can be invested? Tax concerns. How does taxation affect investment decisions? Unique circumstances. Any personal preferences, like avoiding certain industries. Guidelines. Specifies permissible investments, benchmarks, and rebalancing strategies. The IPS is dynamic. It must be updated as the investor's circumstances or market conditions change. 3. Asset allocation strategies. Asset allocation is the process of dividing an investment portfolio among different asset classes, such as equities, bonds, and alternatives. It's a critical decision because it determines most of the portfolio's risk and return characteristics. Types of asset allocation. Strategic asset allocation, SAA. Long-term target allocations based on the investor's risk tolerance and objectives. For example, a portfolio might target 60% equities and 40% bonds. Tactical asset allocation, TAA. Short-term adjustments to take advantage of market conditions. For instance, increasing bond exposure during periods of expected equity market volatility. Dynamic asset allocation. A flexible approach where allocations change continuously in response to market movements. Core satellite approach combines a stable core of index investments with smaller, actively managed satellite positions. Effective asset allocation requires balancing diversification benefits with the risk of overcomplication. 4. Risk management in portfolio construction. Managing risk is at the heart of portfolio management. Understanding and mitigating different types of risks can help investors achieve their objectives more consistently. Types of risk. Market risk, caused by changes in market conditions, such as interest rate fluctuations or economic downturns. Credit risk, the risk of default by issuers of fixed income securities. Liquidity risk, the inability to sell an asset quickly without affecting its price. Operational risk, Risks related to systems, processes, or personnel failures. Systematic versus unsystematic risk. Systematic risks affect the entire market, e.g., recessions, while unsystematic risks are specific to a company or industry. Risk mitigation strategies. Diversification, spreading investments across asset classes and geographies. Hedging, using derivatives like options or futures to offset potential losses. Position limits, setting maximum exposures to individual assets or sectors. 5. Behavioral biases in portfolio management. Investor behavior often deviates from rational decision-making due to psychological biases. Recognizing and managing these biases is critical in portfolio management. Common behavioral biases. Overconfidence. Investors overestimate their knowledge and underestimate risks, leading to excessive trading. Loss aversion. Fear of losses often outweighs the desire for gains, causing investors to hold on to losing investments for too long. Herding. Following the crowd, even when it contradicts personal analysis or objectives. Anchoring. Fixating on irrelevant information, like a stock's purchase price, when making decisions. Confirmation bias. Seeking out information that confirms pre-existing beliefs while ignoring contradictory evidence. Overcoming biases. Rely on a disciplined, rules-based approach to decision-making. Use objective benchmarks and metrics. Seek advice from a diverse group of professionals to challenge assumptions. 6. Ethical considerations in portfolio management. Ethical behavior is essential in portfolio management to maintain trust and ensure fair treatment of all clients. Key ethical principles. Fiduciary duty. Managers must act in the best interests of their clients. Fair dealing. Ensuring equitable treatment of all clients, regardless of portfolio size. Disclosure. Providing clear and honest communication about risks, fees, and conflicts of interest. Confidentiality. Protecting sensitive client information. The CFA Institute Code of Ethics and Standards of Professional Conduct provide a comprehensive framework for ethical behavior in portfolio management. 7. Portfolio rebalancing. Rebalancing is the process of realigning a portfolio to its target allocation. Over time, market movements can cause allocations to drift, increasing risk or reducing efficiency. Methods of rebalancing. Calendar-based rebalancing. Adjusting the portfolio at regular intervals, such as quarterly or annually. Threshold-based rebalancing. Making adjustments when asset weights deviate by a certain percentage from their targets. Challenges in rebalancing. Transaction costs. Frequent rebalancing can incur significant costs. Tax implications. Selling assets to rebalance may trigger capital gains taxes. Emotional resistance. Selling winners to buy underperforming assets can feel counterintuitive. 8. Performance evaluation. Evaluating portfolio performance involves assessing whether the manager has achieved the investment objectives outlined in the IPS. Key metrics. Absolute returns. The total gain or loss of the portfolio over a period. Relative returns. Comparing the portfolio's performance to a benchmark. Risk-adjusted metrics. Metrics like the Sharpe ratio and information ratio account for the level of risk taken to achieve returns. Attribution analysis. Breaking down performance to determine whether it was driven by asset allocation, security selection, or market timing. 9. Sustainable investing. Sustainable investing, or ESG, environmental, social, and governance, Investing has become a significant focus in portfolio management. ESG factors. Environmental, how companies manage resources and impact the environment. Social, a company's relationships with employees, suppliers, and communities. Governance, ethical management practices, and transparent decision-making. Approaches to ESG investing. Exclusionary screening, avoiding investments in industries like tobacco or fossil fuels. Best-in-class selection, investing in companies with superior ESG performance within their sectors. Thematic investing, focusing on themes like clean energy or gender diversity. 10. Global market integration. Globalization has made portfolio management more complex, as investors now have access to international markets. However, this also introduces unique challenges. Benefits of global diversification: increased opportunities, access to faster-growing markets. Risk reduction, spreading risk across economies. Challenges: currency risk. Fluctuations in exchange rates can impact returns. Regulatory differences. Understanding foreign market rules is critical. Geopolitical risks. Political instability can disrupt markets. Effective global portfolio management requires careful analysis of both opportunities and risks. Conclusion: portfolio management in CFA Level 2 is about combining theory and practice to create strategies that meet diverse investor needs. By understanding non-computational topics like the IPS, behavioral biases, ESG investing, and risk management, you can approach this subject with confidence and clarity. These concepts are as important as the calculations, providing the foundation for effective portfolio decisions. Thanks for joining, and best of luck on your CFA journey.